Hi, it's Kristin Jamieson with Success Mortgage Partners. Today we're going to talk about why you should never co-sign for anyone, for any reason in the mortgage loan process. From an underwriting standpoint, we're going to look at a couple things. When you co-sign for somebody, so if it's a new account, say you're co-signing for a car loan, to get the car loan, your credit has to be pulled. So one, it can affect your credit score. You can have a lower credit score in applying for your mortgage or closing on your new home. That debt, say we took out a new car. So that debt that we co-signed for, that that $6,000 car with a payment of $150 for our college student, that $150 has to be counted against you in your debt to income ratio. So it could affect what you qualify for. Unfortunately, there's no way, even if that person's going to be making that payment, that we can exclude that payment until we can prove that they've consistently and consecutively made 12 months of on-time payments to the lien holder. So you're unfortunately stuck with that payment or their payment history until at least 12 months. And unfortunately, times get tough for people, and sometimes they miss their payments. So you as a cosigner, if you had cosigned and they make their car payment, say 30 days late, you now have a 30-day late on your credit report. So that's going to affect your credit score. Potentially you're qualifying. There are some loan programs out there that don't allow you to have any 30-day late payments in the last 12 months. So it could, push you out from qualifying for a home. So it's just really not a good idea to co-sign for somebody, especially if you're thinking about buying a home. Well, they're really, from a mortgage standpoint, I don't know all the logistics on the other side, but from a mortgage standpoint, there really is no difference. What we're going to be looking at again is what's on your credit report, and whether you co-sign, co-borrow, whatever else you want to call it, the account's more than likely going to show up on your credit report. Therefore, we're going to see the payment, which would affect your debt to income ratio, and depending on how new the account is or how many months they've made payments, the inquiry could have affected your credit score. And then the debt can affect your qualifying. The thing about co-signing a loan, again, is, I think we've talked about it in a couple of videos in the past, is that monthly payment that we're calculating into your debt to income ratio. We don't care whether it's a $10,000 loan or a $200,000 loan. It's the monthly payment that we really care about. And for every $50 in a monthly payment, it equates to $10,000 in a purchase price. So it does, co-signing for a loan that we, don't have 12 months proof that somebody else is paying that account that was a joint or a co-signed account, really can affect your buying power and your new home qualifying. Not to mention your credit or your interest rate if they haven't made timely payments, and you see a decrease in your credit score because of it. This is Kristin Jamieson with Success Mortgage Partners. If you ever have any questions on credit or the mortgage loan process or co-signing loans and whether you should or shouldn't, given your current situation, please don't hesitate to reach out to myself or my team at 352-242-1535. Thanks.